going to analyze taxes and tax policy. And first, we'll take a look at the federal government and federal government taxation, and then take a look at state governments. So in looking at federal taxes, we basically see that the federal tax system is a concurrent power between the federal and the state governments. In other words, federal governments can both tax the same things if they want. The local government relies on the state government to give them powers on what they can tax and what they can't. Now, traditionally, the federal government has relied, at least since the passage of the 16th Amendment, on the personal income tax as its largest source of revenue. State governments have historically relied on the sales tax, and now in most states, the personal income tax is pretty much the equivalent of the sales taxes. However, if you take a general sales tax and selective sales taxes that we'll talk about it at another time, they actually now equal more than the personal income tax. So traditionally, sales taxes have been very important for states. And then finally, local governments, particularly school districts in the United States, are funded predominantly by a property tax. However, like the state and federal governments, wage taxes or income taxes or earned income taxes have become important sources of revenue as well for local governments. So in fiscal year 2016, we see that for the federal government, almost half of all of its revenues came from individual income taxes with 47.3%. Second of all came social insurance, or what we would call payroll taxes. These are something that we don't often think about unless you take a close look at your paycheck. But they're very important to funding the government for two predominant programs. The first is Social Security, which is the largest single program for the federal government. And the second is for Medicare, which combined with Medicaid, actually, those two medical programs supersede and are more than Social Security. But Medicare itself is the second largest program for the federal government. So everybody gets taxed equally on their income for social insurance or payroll taxes, and about a third of revenue comes from that. About 9% comes from corporate income taxes, 2.9% on excise taxes. These are just kind of like somewhat similar to a sales tax that the federal government levies, and then there are a very small amount comes from other sources. So if we take a look here at the historical sources of federal revenue from 1950 and just after post-World War II America to the present, we'll see that the social insurance or payroll tax has become much more important as a source of revenue, and corporate income tax has actually gone down as an overall share of the federal revenue. Income taxes have creeped up slightly over that point in time. Again, they remain the biggest source of income, with payroll taxes coming in second. Now, one of the things that we talk about in the United States is, the distribution of income and whether or not it's fair. Well, we have an interesting system in which a lot of people make a lot of money, but a lot of people that make a lot of money also pay a lot of income tax. So let's take a look at a study here from the Tax Policy Center, which looks at the burden of taxation here in the United States. So if you take a look here in the left-hand column, we have the quintiles of cash income, and quintiles meaning 20%. So the lowest 20%, the second lowest 20%, the middle 20%, the top 20%, and then the top 40%. You can see that there. So what you'll see is the top 20% in America, their cash income, those 20% of people make 52% of all the income in this country, right? So 20% makes more than half. Now, when we take a look a little bit and drill down a little bit farther, what you'll see on the addendum below there is that the top 1% of all earners in the United States account for almost 20% of all the income. And the top 0.1% account for almost 10% of all the income. Now, think about that. If you add up the bottom 40%, they only account for about 13.6% of all the income, right? So the top 1% in America makes more than the bottom 40%, which is an important statistic to understand. Now, we have inequality in wealth in the U.S. How about in the realm of who actually pays taxes? So in the individual income tax, what you see is that the bottom 40% actually pay nothing. You see minus 2.7% for the lowest quintile and minus 1.2% for the second lowest quintile. What in essence that means is we have a negative earned income tax that I'll talk about in a minute. So people not only don't pay into the income tax scheme, but they actually get money back out of it. So the top 40% of taxpayers in the United States actually end up paying about 97% of all the taxes in the U.S., with the top 20% paying 82.9%. Now, if you go down a little farther in the individual income tax there, the top 1% of all taxpayers in the United States account for more than 1/3 of all the taxes in the U.S., and the top 0.1% pay 17.3% of all the federal income taxes. Now, what you'll also see is you skip over here, let's skip over payroll for a minute. Corporate income tax falls and a state income tax falls disproportionately on those people that are wealthy, which is not necessarily surprising. The interesting thing is the idea of the payroll tax, because we don't have a graduated system of payroll taxes, meaning that the rich pay the same percentage of their income as do the poor. What we see is that the distribution for the payroll tax is much different than for the individual income tax. And it disproportionately hits poor people in the country a little bit more, right? So if we go the whole way to the right, we see that the top 20% of Americans, as far as income, pay more than 2/3 of all the income taxes in this country, and the bottom 40% pay 3.8% of all the income taxes. So we see two things from this. One is there's an imbalance in the people that have income in the United States, but among those who have income, they also pay a disproportionate share of the overall taxes in the U.S. Now, we have in the United States a number of different tax brackets. It's a graduated system. We call it a progressive income tax, where the more you make, the more that you pay into the system. So there are currently in the U.S. 7 different tax rates. This may well change if we get some kind of tax reform going forward. But as you see, depending on which tax bracket that you are in, the amounts of money that you make go up, and the top tax rate is 39.6% in the United States. So any dollar that you make over $418,000 and $400, you'll get taxed at 39.6%. So that is, in essence, a different tax bracket. If you're married and filed jointly, taxes are a little bit different. Although there are still the same tax rates, as you can see, the same 7 tax brackets. Now, most states also have graduated income taxes. We'll talk about this a bit when we look at state taxes. The highest tax rate in the country belongs to the state of California at 13.3%, and they have about 10 different tax brackets. New Jersey has a number of different tax brackets. We in Pennsylvania only have one bracket, and that's 3.07% applied to income across the board. Now, one of the things that we use in the tax code in order to be able to encourage people to undertake certain types of activities is we provide for what we call tax deductions. And you can limit your tax hit by doing types of things that the government wants to encourage. So, for example, if you have a mortgage on your house, you can deduct the interest that you pay on your mortgage from your income. right? Now, this is very interesting because there are other things that are in relationship to consumer debt, like credit cards, car loans, etc., that also have high interest rates or interest rates that affect individuals. However, we can't deduct that interest, right? Only can deduct the mortgage interest, and that's something, home ownership, something that the government wants to support people to get involved in. Now, there are complicated ways where you can pay off your credit cards with a home equity loan, and you can write off that home equity loan mortgage. So there are a lot of ways to get around this. Charitable deductions are important in the United States. So the money that you give to a nonprofit, recognized charity, is also something that you can deduct from your income. Something that's a source of great consternation between Republicans and Democrats is that you can deduct taxes paid to your state and local governments. So your property taxes and your income taxes or your wage taxes are allowable. For states that don't have income taxes, you can deduct your sales taxes in those states. And Republicans say that this encourages Democratic states to increase their taxes. And the federal government shouldn't be funding that. Democrats argue the opposite. If you have dependents, you can claim them as tax deductions. Child care is another common tax deduction. And if you have a home office for your business, that can be a tax deduction as well, although the government is very strict about that. So, for example, while I may spend a substantial portion of my summer at home because I don't teach during the summer for the most part, I can't claim my office at my house as a home office because I have a physical office at Widener. And the federal government cracks down pretty hard on people with home offices. So what does this all mean? Well, if you take a look at the largest tax expenditures, in other words, the largest tax breaks, economists call them tax expenditures because we're giving out money that otherwise we should be collecting. The biggest single tax expenditure, in other words, the biggest tax break that we have is the fact that we don't charge people for income tax on their medical insurance. Right. So if you happen to work at an employer that provides health care for you, that is not included in your income. It is included as a separate benefit. And if we were to tax that as income, the federal government would raise $235 billion a year, an enormous amount of money, right? A couple of other things that are of importance. Other benefits that we get are also not, like $71 billion a year, are not taxed. Money that are, say, for example, you have a 401k or a 403b, and your company matches that. That's not taxed as income at the federal level. It may be at the state and local level. Child credit, and various other things that you see here. So in general, we're talking about very large amounts of money that go towards these tax expenditures. Now, who benefits from all this? As you can see here, again, we're back to these kind of ideas of quintiles. And, for the most part, for the exclusions on taxable income, it's wealthier people that actually benefit the most, particularly on things like state and local taxes, particularly if they come from states where they have a graduated income tax system or multiple different levels where the wealthy pay more. Wealthy people are more likely to own houses, so they also benefit more from things like the mortgage interest and charitable deductions. The only thing that poorer people tend to do better on is the earned income tax credit and the child care credit. Now, what exactly is the earned income tax credit? Well, this is something that we've instituted in order to be able to provide people with the cash benefits if they are working. Essentially, the government gives you back not only the taxes that you pay, but also additional money to help you make additional, to have revenue to be able to keep going. So let's just say that you were married and filing jointly, and you had 2 children, and you made $14,000 a year. You would be eligible to get $5,600 back in the earned income tax credit. So that would help augment your salary. And it's proven to be, among both liberal and conservative economists, one of the better ways to redistribute income in the United States. Right? So in other words, again, if you are a working individual, you actually get extra money back above and beyond what you pay into the system. Now, finally, what we see here is this is revenues from various sources and then tax expenditures. So, we take a lot of money in, but we also spend a lot of money by not taxing things like individual income taxes and the payroll tax and corporate income taxes. Most of these tax expenditures go to individuals, but there is a striking cost to that at about $1.5 trillion in 2017. Now, remember, we've got a federal budget of about $3.9 trillion and a budget deficit of $600 billion. If we cut these tax expenditures by 1/3, we could deal with the federal budget deficit, right? But there's a lot of sacred cows here. Mortgage interest deduction, things like the charitable contribution, state and local taxes, etc., are very important to middle class people. So that kind of rounds it out, gives us an idea of what we're talking about with this notion of taxes at the state level, and